At the end of 2023, late December, Nike offered a downbeat sales outlook, but it did lay out a plan to cut $2 billion in costs. And our next guest still sees a lot of reasons to be bullish on the stock as we head into 2024, despite slashing their price target on the stock. Piral Dadhania is an analyst over at RBC Capital, luxury goods analyst, joining us now to discuss this. So, Piral, something that stood out in your note is the thought of a product innovation cycle similar to what Nike saw in 2017. So maybe we can go back to what the business did, almost 7 years ago now around its product mix and how you see them trying to replicate some of that success as we get into 2024.
Sure. Thank you, Miles. Right, exactly that. So the new information we learned at the first half results print towards the end of December was management articulating a change in their approach and the fact that they plan to transition the product range. I think this is across price points and across categories, but predominantly, I think, focused on footwear. And that, with the benefit of, leaning back into history, reminds us of the 2017-2018 transition that the previous management team undertook, whereby they effectively they pulled out a lot of the best-selling franchises from the market, and over the course of subsequent 2 or 3 quarters, then introduced new products, new innovation, and different-looking silhouettes in different fabrics, which revitalized, I think, the overall range, and in some ways was the starting point for a new product cycle, which actually benefited them for the subsequent 4 or 5 years after that. Our view more broadly is that the product and brand cycle in sporting goods tends to last anywhere between 2 and 5 years. And really, Nike's coming off a kind of 4 to 5 year run now. Worth also just mentioning that the competitive environment is arguably intensifying. Adidas, its nearest and largest competitor, has probably been a little bit weak in that last 4 or 5 year period, but under new management and with some products which are gaining traction amongst consumers, is arguably going to be a bit stronger in 24. So we believe Nike is just reacting to the phase in the cycle that it finds itself in.
And, Piral, I want to dig down a little bit on the product itself for Nike. Like, are there specific lines that, as you look back at the last 4 or 5 years, I mean, as a consumer, I think of the Blazer line. It's like, I don't know, they have a whole tab now on the site just for Blazers, right? And it used to be, I think they had a mid-top and a low-top. And are there specific, products that you are thinking about they can pull the lever on in a similar way? Because, I think some consumers might be surprised at how much, the revitalization of Pegasus, for instance, could actually drive business results. It feels like it's just a fashion discussion, but how that plays as an analyst to you into the financial model.
It's a fair point. So most product lines, the franchises, typically exhibit a fairly normal life cycle curve, if you like, which everybody will understand well. Over the last few years, products like the Air Force One have been consistent bestsellers. And over the past few decades, I think it's fair to say that Nike arguably has one of the best approaches towards product lifecycle management. And after a sort of fairly strong run over the last few years, it's only natural for them to want to dial down the volumes that they supply into the market. But that does require a period of transition, because the best sellers that are driving the revenues today need to be replaced by something new, which isn't necessarily well understood or driving significant volumes today, but with a view to driving growth in the future. So it's a fine balancing act, but really we're talking about the performance running side of things. When you mentioned the Pegasus, the 41 is due to be launched in April, I believe it is. Their intention, we believe, is to not allow the Pegasus 40 to be discounted too heavily in the marketplace. And to do that, they need to ensure that there isn't excess product out there in time for the launch of the 41. And then I already alluded to some of their lifestyle products. So the Air Force One, for example, the Air Vapor Max, some of the Jordan lines, I think, need to be refreshed as well. So I think this will be probably a year of transition. In the 2017-2018 example, it certainly took 3 to 4 quarters, I believe, for that transition to really take hold. the intervening period can be, I guess, volatile to an extent, and there is a little bit of execution risk that's associated with that. And arguably and naturally, given where the consumer demand environment is, given where we are in terms of the broader inventory cycle for the industry, that does create some headwinds perhaps in the first half of this calendar year.
Piral, how are you factoring in some of the weakness that we've seen overseas, especially in China? How is that factored in then to your outlook? And in terms of that turnaround story or waiting to see a bigger rebound, how long do you see that, or I guess how far has that been pushed out for that to turn around?
China's a whole different topic. It's a very important one. China's something like 35 or 40% of revenues, if I remember correctly. They did flag on the second quarter earnings call that they're seeing a softer demand environment in their DTC channels from a traffic perspective globally, but they specifically called out China and the EMEA regions. That's not to say the other regions are not immune to that either. However, when you look at estimates for the second half of fiscal 24, but also going into next year, China will arguably be still one of the fastest growing regions. So actually, in terms of growth contribution, China is still very important. What Nike's done better than peers is two things. Number one, it's been able to deliver stronger revenue growth than its peers through the COVID period because it has a much better DTC business driven by its apps and a digital platform. But number two, and perhaps as importantly, it's managed to maintain a profitability profile in China, which has not collapsed like it has for some of the other peers. And so from that perspective, arguably Nike's business in China is a better quality one. It, out of the Western sporting goods brands, we would argue is best positioned. And there are some changes taking place in the Chinese market as it relates to the competition between international brands such as Nike, Adidas, and so on, and the local brands such as Li-Ning and Anta, who through the COVID period saw significant growth. You may have seen the recent share price moves in stocks like Li-Ning, which are down 70%. There is a bit of a, how do I explain it? Arguably, those brands, the local brands, took too much pricing. They tried to elevate from their core competency. And now with a less favorable macro and consumer backdrop, their positioning looks stretched. And at the same time, the Western brands with clean inventories, with, I guess, a revitalized business model and strategy are taking back some of that momentum and share at the expense of the local players. So actually, we're fairly encouraged and positive on the China outlook for over the next 12 to 24 months.
All right, Piral Dadhania, Markets Executive Director and Luxury Goods Analyst with RBC. Thanks so much for joining us here.
Thank you.